Hey, welcome back. With Starbucks being down quite a bit from its peak and getting a lot of attention recently thanks to a very interesting plan, let's see if there might be an opportunity here. They can currently make around 3.5 to 4 billion per year, but with significant capex. This is part of a plan that they have, but more on this in a second. For a roughly 100 billion market cap, that's a pretty high ratio of around 25. Even with the normal capex, it would be something like 20, so from this point of view, they're at a pretty fair to high valuation. But this is pretty much around the average or even a bit below it for Starbucks. They have 6.5 billion in current assets, which isn't enough to cover the current liabilities, and overall the total assets don't cover the total liabilities. So they have quite a big issue. The debt is spread pretty well in the future, but the interest is 1.5 billion and the dividend is another 2.6, so there goes the cash flow. Not to mention the massive buybacks. The debt repayments might be a bit of an issue in 2025 and 26, but they can just issue more and refinance. They even have some notes in the 2050s for a small interest rate, so the market has been pretty confident in them so far. Overall, the average interest rate is really not high at all, but if the Fed doesn't reduce the rates for 1 or 2 years, refinancing this can pile up the interest and then the issues would begin. But if they focus on improving the balance sheet, based on the current cash flow, it can look much better in 3-4 years. However, the dividend would have to be cut, but in just a couple of years, this can be a much better company. This is ultimately a matter of management, but they seem to be focused on other things. Overall, this isn't the most financially healthy company. There is a reinvention plan that looks pretty promising as they focus on growing the number of stores, especially in China. There is still a lot of money that can be made internationally, so focusing on China, India, Europe and so on can still unlock a lot of growth. And the good thing about opening a store is that they open it in a few months or even less and it produces money. So they already have an impact on the earnings, as you are about to see in a bit. It's not a mine that they have to prepare and get all the approvals or a product that they have to create and market, it's a Starbucks. As a result, the capex would basically double from 2-3 years ago, so you can say that they are in an investment cycle. If they keep going, lower interest rates might also be pretty good to have. We can see significant changes in the management recently, and this geographic focus can maybe help with the plan as each of the CEOs would have a clear focus on their markets. I think they should focus on the whole workplace alternative and the overall experience of being in a Starbucks because it has potential in the long term. The EPS guidance is also very interesting. 15-20% growth for such a big company in the current environment is very attractive. This is related to the plan, and if they manage to do it and keep doing it in the long term, this can help improve the balance sheet without having to cut the dividend. Now, can they reach this level of growth? Well, it's not impossible at their size, and for them it's actually below the average, and if they do it, the stock usually tends to follow. Now, the main issue is that this industry is extremely competitive. Anyone, and I mean literally anyone, is able to open a coffee shop. It's a relatively very small investment, there is little need for know-how, and you can find all the suppliers and the whole distribution system without any issue. Sure, maybe they don't even survive in the long term and they don't have nearly the same power of negotiation, but they are still competition. Almost any coffee that they sell is a coffee that Starbucks could have sold. However, the power of the brand and overall business intelligence in selecting the real estate and the distribution system and everything is probably what allows Starbucks to keep developing. I'm not a coffee drinker, but I think their coffee isn't that great and it's pretty overpriced. But they were able to build a $100 billion company around it, and that's not easy to do. You know, back in university, Starbucks was, and probably still is, a prime example of a powerful brand. Anyway, this is going to depend on the economy. In a recession, although coffee is not really a traditionally discretionary item, Starbucks can still be affected. Even though people can be pretty addicted to it, they can go for a cheaper option like making it at home. But on the other hand, rate cuts will increase the discretionary budget for many people, which can be great for Starbucks. Plus, it would also help the development in China and India directly. And another thing, it would make dividend stocks more attractive. As for a valuation, let's look into 3 scenarios. In a negative one, with competition, the plan not working and so on, let's say the cash flow drops to 2.5 billion as it was in 2022. Assuming a ratio of 15 in the long term, which is still relatively high, that's a market cap of 37.5 billion, meaning a price of only 33.12. That's a 60-something% loss, but the even bigger issue is that they won't have enough money for the dividend after they pay the interest. With debt repayments, they might not have anything for a dividend, so such a crash can be expected. In a second scenario, let's say they remain at around 4 billion per year in the long term. For a ratio of 20, that's a market cap of 80 billion, meaning a price of 70.66. So currently they are below this value by 10-20%, which isn't that bad. For a dividend or a retirement portfolio, I can see this as a decent price, but not really good for a value investor. In a good scenario, let's assume the plan is working and in half a decade, the cash flow from operations stabilizes at 8 billion while the capex normalizes at around 1.8. That's a free cash flow of 6.2 billion. For a ratio of 20 again, that's a market cap of 124 billion, meaning a price of 109.51. So a decent 25-30% profit. However, in such a scenario, the ratio can be even as high as 30 since they could increase the dividend significantly. That would be a price of 164.28, so a 60-70% profit plus a nice dividend. As you can see, there is potential, but at this price it's not really as much as I would want. At the current price they can do as the average of the market, which isn't bad, but there is also risk. So SBUX is not really a buy for me at the current price, but I can see it as part of a slow retirement portfolio for example, although the balance sheet is quite an issue. My entry price is very far from the current price, maybe something like 30 or 40, so I don't think I'll ever be able to buy this. So not for me, but it depends on the reason why you invest. If you're happy with 6, 8, 10% per year with the dividend, this should be fine, but the balance sheet for me is a big deterrent. You know, don't get me wrong, it's a good business with an extremely powerful brand that's invaluable, but I wouldn't call it a strong buy at the current price. Overall, this is an interesting company and they have issues, but there is also potential, especially if they grow as they expect. With the new management and the plan, maybe they can continue the legacy of the brand and even improve it. I really think they should focus even just for a couple of years on reducing the debt, and then this would be a much better company. And you know, I think if you bought the stock instead of the coffee during the past decades, you'd be much happier today. The same for Pepsi, Coca-Cola, McDonald's and so on, but that's something for another video. As always, what I cover in my videos shouldn't be enough for you to make any investment decision, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out, and make sure to subscribe. Thank you for watching and I'll see you next time.